discuss the prospect of investing in gold as a long term asset class and what are the reasons why one should consider gold and what are the pros, what are the cons, and how does it fare with real estate over the long term. So let's jump right into it. All right, and so this is the slide for the day. And the question that we intend to answer is: should one invest in gold for the long term, and how does it compare to real estate? So, let us first begin to understand what are the fundamental factors behind which one should strongly look at gold for the purpose of long term investments. So, first of all, in March 2019, gold has been shifted to a tier 1 asset class by Basel III guidelines. So, Basel III guidelines are the guidelines that are applicable to all central banks. And what they have done is they have moved gold, which was earlier a tier 3 asset class, into a tier 1 asset class, which makes gold equivalent to cash. Now, this has been the update since 2019, and by moving gold to a tier 1 asset class, it structurally alters the role of gold as a collateral and the minimum amount of gold that is required for a central bank in order to create assets. So now the question is, why did gold move from tier 1 to tier 3? So in 2008 crisis, we understood the vulnerability of the real estate market as an asset class. So what happened is that, let us assume you purchase a piece of real estate at rupees 5,000 a square feet. A year later, the perceived value of that property is 10,000 rupees a square feet. When you mortgaged that real estate, you mortgaged it at the rate of 10,000 rupees a square feet, which is what the bank agreed to pay to you. And when this was done by everyone, that they mortgaged a piece of real estate at its perceived value, and when they defaulted on their loan and the bank went to claim that real estate and went to sell it in the market, there were no buyers for that perceived value. And what it basically meant is it exposed the illiquidity in the real estate market, and one began to realize that the actual price of the real estate market cannot be used as a basis for long term lending, and therefore gold has been raised to that particular standard, and it is gold that is now taken the space of real estate as well as many other asset classes. So now this is the fundamental trigger, and this explains why there is a rush from central banks of most countries like Russia, China, Iran, Turkey, etc., to purchase gold. Because in addition to the mandate of having gold as a tier 1 asset class, these countries are constantly under the threat of US imposed sanctions, which restricts the movement of US dollar for them, and therefore limiting international trade opportunities for those countries. So therefore having their own currency backed by gold increases the strength of their particular currencies as a fundamental measure of value. Now, these are the fundamental reasons. Now, the question is, how does it impact us in India? Now, in India, it is a common phenomena that a house of roughly rupees 10 million, that is 1 crore rupee, fetches you an annual rent of anywhere between 3 to 4 lakh rupees. I've just approximated it to 3.5 lakh rupee. Now, tax adjusted in housing, you have the opportunity of showing expense and getting say 22% tax, and but let us just assume 30% is the tax that is deducted from your income. You basically get somewhere between 2.2 to 2.7 lakh rupees for a property of 10 million that has been rented out, and this therefore gives you an average rental yield of 2.5% post tax. Now, when we look at the sovereign gold bond that has been issued by the government, we see that gold also offers the same yield of 2.5%. Now, the only question that we need to answer is that let's assume that the piece of real estate that we are trading in is valued at 5,000 rupees a square feet. The reason why you're buying it is because after a certain number of period, let us say for example 8 years, you expect it to be say 15,000 rupees a square feet. Now, the same question is there for gold, that will gold, which is currently priced at rupees 5,000 a gram, will it be worth say 15 after 8 years? Will it be 15,000 rupees a gram? Now, The same speculative question is there for gold as an asset class as is there for the real estate. The only difference is that gold is a tier 1 asset class which is equivalent to cash, fetches you tax free rental yield without any stress of for tenant illegally occupying paperwork, and simplifies the process, and also maintains the same potential as, if not more than, real estate to appreciate in value given the fundamental move that has happened in gold. So, this is the premise for which I suggest that one look at gold as a long term investment. And the biggest advantage is that you need not undertake any liability to buy gold. So, which means that if you have to buy a real estate house, it might cost you, say, rupees 10 million. You need to have 2 million upfront, and you can take a loan of the remaining 8 million, and you need to figure out if you are net cash positive in the exchange. In case of gold, you could start buying with as little as 1 gram of gold without putting any pressure on your balance sheet, and you are in effect purchasing a property like asset only in fractals. So now let us just understand how this fares in the long term. So what I have here is the long term price chart on weekly time frames of the Indian real estate market, which seems to have peaked in 2010, and since then it is trading at roughly half the value. Of course, the reality index is not an accurate benchmark of the real estate market as we see it, but it is fair to assume, given the size of the companies that are in this index, that it is a fairly reasonable measure, at least in tier 1 tier 2 cities, on terms of the profitability of this particular segment. And now we will see that the real estate market has clearly created a bottom in 2014, and this coincides with the issuance of the sovereign gold bonds, coincides with the election of this new government. It coincides, we can see the stress it had in 2016 with the inclusion of RERA and many other factors, and also the housing for all scheme, and the fact that there is another asset class which gives you the same rental yield as real estate. There is definite pressure in this market, but we can see that the bottom has also been formed. So it is safe to assume that the Nifty reality has formed a bottom, and it is likely that the real estate will not dip any further, but whether or not it will double or triple in value remains to be seen. When we compare this to, say, for example, gold mini, I mean, say, if you just, or just gold in general, think it is XAU USD. All right. So now what we have here is we are basically seeing that gold has taken out the 2011 high against the dollar and is showing a pullback. So definitely this on the surface, I mean, given that it has created a new all-time high against the dollar, but when we see the same price against the rupee, so just sorry. So when we see the same price action against the rupee, we see a significantly stronger breakout from its previous all-time high, implying that gold is has shown strength against the dollar in the past, is currently in the corrective phase against the dollar. It is also in a corrective phase against the rupee, but wherein the dollar it is testing the previous 2011 high, it is nowhere close to that against the rupee, which means that the rupee indicating clearly, and the fact that we all know that rupee is weaker than the dollar. So in this context, since that it looks like gold has a clear cut breakout and is comfortably trading above its 200 moving average, whereas in comparison we see the real estate companies and the index in general ranging, there is a case to be made for the small investor to consider investing into gold, and we recommend that you do so by buying into the gold bonds that have been released by the government. Once you do buy into those gold bonds, this is how they will look in your portfolio. For example, you will see SGB October 28. What this basically means is that I have bought a sovereign gold bond which matures in 2028. Since the gold bond has an 8-year expiry, it means that I have bought this in October 2020. Similarly, so this is 1 gram. You will see October 27, 3 grams. So, which means I bought this in October 2019. October 27, 15 grams. October 25, which means I have bought this in 2017 because the maturity is going to happen 8 years later. Here I have bought 5 gram. November 28 means November 2020. November 24 means November 2017. I had purchased 20 grams. Similarly, if we go, we see 25, 25, 27, 25, 28, 29 Jan, which means that as late as January 2021, also I have made a purchase on gold. And this process continues right up till, like, say we have here till August 24, which is the last in the entries in gold, which means that in August 2017 also there was say 17 grams of gold that were purchased. My point being that I have gold in my long term assets. I do not own real estate directly through my own money in long term assets, and I use most of my capital for trading. So I do have a few equities in the long term, which are shown here, but this is ongoing. My predominant play in the market is usually through the futures market, and in my holdings, as I have shared, gold forms a significant part of my long term asset class. And I do recommend that sovereign gold bonds, given that they're risk free, pay you 20% dividend over an 8-year period in a commodity that has created an all time high against our currency, is certainly something that we must consider for long term investments. So I hope that this video helps us answer the question that should one invest in the gold for long term. The answer is yes. They should do it in fractals, they should do it via sovereign gold bonds, and they should definitely look at it as a better bet at the moment, given the information we have, than real estate. So yeah, so I hope this benefits. Have a good week ahead. Regards.